Hello and welcome. You are listening to the Investor Lab. My name is Goose.
And I'm Charlie.
And on today's episode, we are starting a fantastic and exciting and revolutionary new series, a micro series that's going to sit within the Investor Lab, and it's called Property and Business. Now, most of you guys will know who I am because you've been listening to me for a little while, and I think you've been enjoying the stuff so far. But I wanted to take a moment to introduce my co-host for this series, Charley Valher. Charley runs Valher Media, and he is well known amongst business circles. He's been in business for a long time, and he's also a good friend, colleague, client, and all of that kind of stuff as well. So we decided we wanted to pursue a narrative designed to solve the problems in the minds of business owners, particularly around real estate investing. Is that right, Charlie? Anything to say to that?
I just want to concur that I think we really want to look behind the curtain for business owners, really making it specifically my own journey here is property is a little bit different for business owners. Your borrowing is different. Your attitudes are different. The way you think about things is different. And I guess I'm hoping, or actually I kind of know because we've already made some stuff, that we can kind of help business owners understand how this can be a huge win and work for them.
Absolutely. Now, if you're not a business owner, you might be thinking, hang on, do I switch off now? Is this not going to be for me? I can guarantee you, my promise to you, in fact, I will give you a 100% money back guarantee that the content that we cover in this episode and the future episodes of this series will be highly valuable, whether you're a business owner or not. But if you are a business owner and you've either thought about investing, maybe you've started investing, or maybe you've never invested, then this is going to blow your mind. You're going to have quantum paradigm shifts in the way you think about wealth creation and what your life can be like. Now, in this episode, we covered heaps of really good ground. We really tried to tackle one big question: why business owners need to build wealth, both inside and outside of business, and what they can do. We covered what are some of the stuff we covered, Charlie? We covered why even bother investing in real estate, right? That was a big one.
Yeah, a huge one. And I think we covered well the aha moments we both had that really had us pick real estate as a path or something we really wanted to get involved in, which I thought was really cool. And then I really enjoyed, there was a component where you kind of shared your three things that make the difference. Like if you do these three things when it comes to real estate, you're going to have a much better experience.
Yeah, 100%. We also talked about when and why. So firstly, why even bother investing in property? We covered that in a really big way. We talked about our personal journeys, about how we sort of found our way in this space in our own unique ways. We talked about when to start, when to take profits out a little bit. We kind of talked about that kind of stuff. Well, I know we covered we covered a couple of little controversial topics. Firstly, we covered the controversial topics of potential returns, which is a big one for business owners to understand. And we also covered another big one around the big kind of myth that the big issues that a lot of business owners have when thinking about property, and the fact that they basically just don't even understand it.
Hugely. I would just say that that's the thing. How to think about property when you are a business owner is such a unique thing I haven't heard elsewhere.
Yeah, absolutely. And we covered the similarities and how you actually need to think about property as a business, which is a big one, because whether you're a business owner now or not, if you are a property investor, you are a business owner. That is just the reality, and those are just the facts. So we talked about it. We even touched on stuff like how to identify growth areas and what influences market cycles. We talked about another controversial topic that Sydney and Melbourne are the two most volatile markets in the country. We covered a lot of ground in this one, Charlie.
And we're just getting started.
We are just getting started. So if you have any interest in business or real estate, then the Property and Business series is absolutely for you, because this is specifically designed to take a different view, a different angle, and to expose a different thought paradigm, narrative, and voice to a very interesting collision of two unique and exciting worlds that we're both extremely passionate about. And Charlie, I'm really excited to be going on this journey with you. And we don't even know how many episodes we're going to do, right?
Oh, well, hopefully some of the people who listen to this will reach out and say, oh, you guys are duds, stop making this, or, ooh, let's do more. And hopefully we can turn it into something much bigger.
Absolutely. So if you receive this via email, you might get an email from me, you might get an email from Charlie, you might get an email from one of us. If you get an email from this, check it out. Hopefully, if you are listening to this, you're checking it out. So thanks, that's good. Respond to the email, just reply to the email and say, hey, this was great, or can you talk more about this, or give us some feedback, because your feedback is going to help us shape the narrative around this conversation so it can be even more high value. But we know we've got a lot more planned. I can't wait to get stuck into it. So if you want to know, where are we going to send people? What's the call to action, Charlie? We hadn't discussed that.
I'll tell you what, maybe we just leave them in suspense and say, make sure you tune into the next episode that comes out of this, because you're going to want to make sure you subscribe to the podcast. Probably leave us a review as well if you can. Hint, hint, nudge, nudge. Yep. And then make sure you tune into the next part of this series as well.
Absolutely. Without any further ado, we look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. But this is not your average Investor Lab episode. In fact, I am joined today by a very special friend, a client, a colleague, a peer, and his name is Charley Valher. Charley, how are you today?
I'm excellent, Goose. I must admit, I'm a little bit nervous. I've done a lot of podcasts in my time, but never one on this topic. So let's just say I'm hoping to deliver on a level that meets my and your expectations.
Well, I'm sure it's going to be great. So, okay, so let's give this a little bit of an introduction. And so what we decided we wanted to do, so Charley, you're a business owner. You deal with a lot of other business owners. I'm a business owner. I deal with a lot of other business owners, and we both have a passion for property. And we wanted to combine this to create a special series that is specifically designed to answer some of the questions and to solve some of the problems of business owners who are interested in investing in property, right?
Absolutely.
So now, if you are not a business owner, don't think that this isn't for you, because this is going to cover some awesome stuff. But if you are a business owner, then this is going to be absolutely dynamite, because we're going to be digging right into it from two very different perspectives. I mean, my perspective is that I spend all my pretty much 7 days a week thinking about property, but also thinking about business. And Charley also does it the same, but in a slightly different way. So Charley,
I feel like we're reversed. It's like I feel most of my time is on business, and then all my spare time is on property. And then you get to, of course, your lanes are more closely aligned, but it's like you've got this big property foresight and mind that I realized is very different to mine. But then you've got the whole business acumen as well, which is why I think the conversations are so interesting.
Absolutely, I wholeheartedly agree. Which is why I'm excited. I mean, we don't even know how many parts there are going to be in this series, because there is so much. We've been talking over the last few weeks about all of these different ideas and all of these questions that we want to talk about, and so we're just going to give this platform enough time to breathe. And as long as we're bringing value, I think we'll keep doing it, right?
Absolutely.
So, Charley, why don't we kick things off? So, what we're going to cover today is starting with a fundamental idea. I mean, for a lot of business owners, a lot of business owners have never thought about property. And I know this because so many of my friends are business owners, entrepreneurs and stuff like that. And they're all really, really good at business. Right? They're all like absolutely crushed it, really good at marketing. They're really good at sales. They've got great teams and systems and all of this kind of stuff. And fundamentally, I don't know you're probably the most property knowledge advanced of any of the business friends that I've got. And I think there's a huge gap, because a lot of business owners think, well, why would I want to take my money out of business? Like, why would I even invest outside of business? Can you tell me a little bit about what your pathway was with that?
It's a big question and a great question. I think I had what I would call a light bulb moment. I had something where it's like you're one person one day, and then you're a different person the next day. Like I had learned something I can't unlearn. And I had this moment where it's like, to be honest, things were really good in business. Like we're making money. Everything was coming together. And then I had this idea of like, well, how does this actually lead to the future I want? Like, where's the opportunity for like retirement? Or where's the opportunity of like, how does this all play out? And I'd made some assumptions. I thought, well, maybe I'll just sell my business. Maybe I'll run it until the end of days. And I looked at all these things, and the one that really got to me was Kodak. Kodak really, really got to me. And I have to give that context. Kodak was perceivably like one of the biggest, powerful companies at the time. Yep. Right? And they actually even invented the digital camera, which I think is so ironic in their demise. But when I looked at it, you had this juggernaut of a power business, and time wasn't kind to them. As things changed, they didn't necessarily evolve or adapt, and their future became very bleak. I'm sure most people know the story. But for me, I looked at the industries I'm in, and I'm like, are they going to exist in 20 years? Am I banking on an exit that may not happen, or am I assuming the landscape's going to stay a certain way? And I didn't feel very well diversified, and I didn't feel like I'd necessarily given myself the best odds or chances to achieve the best result overall. So that was the like, oh, I'm not sure I'm comfortable here. I think I need to get myself educated.
Yeah, it's crazy, isn't it? Because for some people for people who aren't in business, they look at business owners and they think, oh, that business, you own a business, you make loads of money and life's great, right? But the reality is for most business owners, there's a real challenge at the start, particularly at the start, to like, how the hell do I even do this? And it is one asset class. Like business is just an asset class, right? And it's a very active asset class. And that's kind of the problem. Now, you can look at the gains that you can make in business. I mean, just look at Amazon. Look at, we were actually discussing yesterday how disgusted you were at the current share price of Apple, right?
Very, to be clear, still am.
So, like, you can make astronomical sums of money in business, but we're talking about the absolutely fractional minority of businesses that achieve that level, those levels of kind of wealth and growth. The reality is, in any case, that it takes a lot of work and it's a very active strategy. So the way I see business is a cash flow strategy. Now, the problem that I see with a lot of business owners is that, as you kind of pointed out, like, okay, you've kind of worked out business, you've got a business, it's making money, okay, life's good, you've got a team, cool, you've got a system, great, fantastic. But there's kind of two fundamental problems, and you sort of touched on it there. What happens next? Like, do you just keep doing this until you're 60, and then what? And then what? Or alternatively, if you don't want to keep it, that to me just sounds like a job. Like, so you've essentially worked really, 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 really hard to build the skills to take a lot of risk to essentially have a job. Got it. Okay, cool. Nothing wrong with having a job. That's all good. So that's one big issue that I see. But then the other issue that I see is for business owners, you can work really, really, really hard and you can build this asset that requires you to tend to it. It requires you to attend to it. Now, there's a lot of people out there like Michael Michalowicz who talks about, the idea, and, Michael Gerber and all of these kind of guys that talk about the idea that, it's not a real business until you can take time away from your business and it can flourish without you. Now, the interesting thing with those kind of ideas is the litmus test they use for that is typically, can you go away for a month? Right? That's typically the litmus test, which is all good. But I don't know of a single business. There's probably a few, but there's probably a couple. But realistically, 99.9% of businesses, if the business owner doesn't show up for, say, 12 months, that business isn't going to be, it's certainly not going to, if it still exists, it's not going to be as healthy as it once was. And so I kind of see there's this big challenge there that business owners can actually get to a point where they can make money, but then actually have no way to break free from that structure that they've made. Does that make sense?
Oh, you're hitting some nerves. I'm probably one of the few. I'm very fortunate where I probably could take a month off or 3 and not really do any severe damage. My business would run. I won't say fantastically to the best degree, but it would run. But I look at that and just go, that's not necessarily the achievement I'm trying to unlock here. Like, and Keith Cunningham says this, and I love that he takes a dig at Tim Ferriss when he says it. Working 4 hours a week is a great idea if your competition is working 2.
Yeah, totally.
And I just think the same thing is kind of existing here. Like, you can still have a well-optimized business where you can have really good leverage, but I still think that doesn't necessarily hedge against the idea of doing other assets or doing other things. I think there is the opportunity for both, and an overall better outcome is achievable in both, which is where it all comes together.
I 100% agree, and I think that's where you start to optimize. I like to call it optimizing for fulfillment, right? So if you just optimize for profit in your business, that's great. But again, it's going to be a relatively fragile strategy. As you said, like, you're not trying to optimize your life to be able to take 3 months off. Like, you want something more, right? You want higher levels of fulfillment. Now, fulfillment can mean a lot of different things for a lot of different people, but that's ultimately, I think, the aim of the game. Now, the problem is, though, that just in the same way that if you kind of combine different asset classes together, you can actually start to magnify the results. Like, if you can actually work out, firstly, why you would even take money out of the business, like, and how to do it well, you can actually start to create an environment where not only your business is healthier, but you actually have more passion in your business, and you've also set yourself up with an exit strategy that doesn't rely on you trying to potentially maybe sell your business. And let's face it, most businesses aren't actually set up to sell anyway, right? So they're not actually sellable, most businesses. So the reality is, if you actually play this game right, you can build a business, generate profit, move that into an asset class which can generate more profit, compound your wealth, and actually give you that liquidity and freedom that allows you to just show up in your business as a completely, passionate, and fully present individual for the long term. And I think that's a huge key to unlocking fulfillment for any business owner.
Hugely, absolutely hugely. Like I will admit, I've noticed a few things that since I've been on this property journey and doing things, the idea that I'm not reliant has really like impacted certain risks or behaviors. It's like, okay, well, if this all, and not that I would ever intentionally do this, I would say, but okay, if this doesn't work out, I'm fine.
Yeah.
Like it's completely fine. And I think that's a very interesting mindset to come into the world with.
100%. I was talking with a business owner yesterday, and I was explaining to him about he totally just didn't really understand. He literally was like, "Why would I bother investing in property?" That was literally his position. And I said to him, I was like, if you got hit by a bus, let's just say you walked out of where you are right now, you get hit by a bus, and you went into a coma for 12 months. Firstly, would your business survive? No. Secondly, if you actually built a property portfolio in the right way, if you divested some of your profits and set up another wealth strategy, could you theoretically at least wake up 12 months later and be wealthier and better off? And if you do it properly, you can. But then also then we've got to start thinking about strategies about how to do that. But once you can start to set up different pillars of wealth, you start to create that opportunity, that freedom that you go, well, even if this failed, right? Hey, guess what? Maybe there was a pandemic and the business failed. You know, maybe there's something like that.
I can't believe you can say that and it's legitimately true, by the way.
Yeah,
Some weird times. Anyway, continue.
Exactly. I mean, like right now more than ever, everyone's fully aware that the best laid plans don't always eventuate. And so actually having another strategy that can support you so that realistically, no matter what, you can do whatever you want. The way that I explained it to this guy, and it was completely blew his mind, if he was to start taking profits out of his business, and if he was to start investing in real estate, which is what we're going to be talking about a little bit on this podcast, investing in real estate that would grow in value, and I explained to him the benefits of that, and also produce a surplus income stream, he could literally, now this guy runs a copywriting business, right? So he loves writing. And I was like, dude, you could actually feasibly, you could go to Barcelona, move to Bali, do whatever you want. And you could actually take 2-3 years, go overseas, do whatever. You could sail the world if you wanted. You could actually do these kind of things, which seem like a fantasy, but you could actually come back to Australia and actually be much wealthier and much better off than if you had actually even just stayed and tried to make it work. And the reality is you can actually create a second income stream that can actually fund you to do that kind of stuff too, which sounds like complete nonsense. But I mean, the maths is just there to make it a possibility. So
I'd love to ask you this, Goose, because this has been one of the things that I have very much challenged my own thinking on. So even in my own environments now, I look around and most of the business owners I look at are working pretty hard. Yep. In fact, I actually don't know any that really don't work hard. They're all putting in the hours and doing what's required in general. What I would say though is that it almost seems like too good to be true. Like you really struggle to wrap your head around it when you look around and that's the environment you're in.
Which part of it? Like the fact that everyone's working too much or the fact that you can actually have more freedom?
All right, so let's lay this down. We'll use your examples. Like let's say you are this writer and your environment is everyone around you is working hard, buying a house they live in, doing all these things, and you think that's the way. Like you're conditioned to think this is normal and how it's done. And you tell a guy, hey, if you moved over to Bali, not that I'm sure you can do that right now, but insert that option, and you could be doing these things remotely. It kind of goes, it can be hard to make that jump mentally. I think it can be very, very difficult for someone to kind of realize this is an option for you.
Oh, insanely so. A guy actually that we both know, Ben is his name. I was talking to him about it. He was talking about me about he's finally got to that point in his business where he's producing enough surplus profit reliably, producing profit in the business, and he's like, okay, well, now what? He's got that question that comes up anytime for any business owner at a certain point. They're going to be saying, well, yeah, and now what? So I was talking to him about that, and I was saying, okay, well, what do you want to try to achieve? What do you want to do? Blah blah blah. He's actually moving to France right now because his partner's in France. Now he was saying, look, ultimately I want to achieve this. The next day, I want to buy an apartment in Paris, and I want to buy a place in Sydney, and blah blah blah. And it costs $10 million for this, and I was like, okay, so why do you want to own an apartment in Paris? He's like, well, what do you mean? I was like, well, I mean, I can understand you want to live in Paris, but like, why do you? That's like you'd be tying up like $2 million of capital to do that. And he was like, well, because that's what you do, right? You buy a home and so maybe I'll have a home over there and I'll have a home over here. And I was like, yeah, but is that the best way to spend your money, Ben? And I said, wouldn't it actually be better if you could take your profits, invest them in assets that could produce enough equity and revenue to cover the cost of you living wherever you wanted and run your business from wherever you want? And it was he had a bit of a meltdown. He was like, oh my God, I've been indoctrinated my whole life to believe that I need to own a home. And if you look at arguably some of the, I won't say necessarily the most successful, but they are very successful, but probably the most famous property investing people like Grant Cardone, Robert Kiyosaki, they're all rentvestors. There's a massive reason for that. Your home is a liability. That's the reality of it. It's a cash liability. It's a debt liability. And I'd say 99% of any of the successful investors that I've ever known, seen, or read about in Australia all rentvest. And I think there's a huge thing there for business owners as well to understand that you can actually achieve greater levels of freedom, time freedom, financial freedom, because you can actually create better financial benefits, reduce your costs, increase your returns in your own life, and also create greater levels of fulfillment just by thinking about how you're operating in your current matrix.
Some big topics there, looking to really take down some big organizations, already attacking the Australian home as a liability.
Yeah, it is. It is.
I agree. But Goose, I'm very curious. I'm pretty confident you didn't start as a kid in property, and
no,
it was something that was. And I know a bit of your backstory from your book, and you come from festival world of all places, which is very different to real estate in my mind. I imagine it's a different ecosystem altogether. But what made you suddenly go, property is the thing for me? What was the conclusion or the aha moment or the realization you had, which made you go, look, this is where I want to be. I can see this is the best opportunity for me, and I'm going to spend a lot of time here.
Yeah, so it's probably worth giving a little bit of backstory. By the way, if you haven't got a copy of my book, you can get it at renegadespropertybook.com. But it's worth giving a little bit of a backstory, because you're right. I was in a completely different industry. I had no idea about property. My family weren't a property family. My parents have never invested in anything at all. I remember when I was younger, my brother was sort of talking about, you can't go wrong with bricks and mortar. And I was like, I don't even understand what you're saying. And my journey was that I left high school. I left high school early because I was already running my own company. And I spent about 13 years traveling the world, organizing music festivals, doing heaps of cool stuff, had companies in 3 different continents. But I was, as you can imagine, 13 years of traveling the world, doing music festivals, I developed some pretty bad habits. And at the end of it, as I started to get towards, I guess, the end of my lifespan within that sector, I was burnt out. I'd been working 100-hour weeks. I had no savings. I had no money. I had no home. I was living in my office. I was an alcoholic. I was a drug addict. Life was pretty rough. It was pretty low. And that probably would have been me really until I met my partner, Gabby. And it was only through meeting Gabby, who's a much better human than I was at that point, that we started to think, okay, well, what are we going to do to get ahead? And I started going, well, if I actually want to keep this lovely, person in my life, I actually need to become a better person. And what's not working right now is working 100-hour weeks and having nothing to show for it, because we'd make money, we'd spend money, and it was always we'll just get more contracts, we'll just do more stuff. And we never really had a plan. We never had a continuity plan in life. Anyway, so Gabby and I went out to buy a property. I remember talking to my business partner at the time, and we had this great conversation. I'm sure that you have probably thought this too, and I'm sure that pretty much every other business owner, any other person has thought this too. I said to him, my business partner at the time, I said, so, all right, because he was thinking about buying as well. We were both starting to think, hang on, something's got to change. And I said, so property doubles every 7 to 10 years, right? He said, yeah, I'm pretty sure that's how it works. And I was like, okay, so pretty much you just buy any property and that's it. Because we could see all of these people who'd made tons of money. I mean, his parents bought a property in Melbourne for $75,000 and now it's worth $2 million. We're like, all you just got to do is buy, right? Just buy anything. We thought it was that simple. So Gabby and I went and successfully, sorry, you're smiling there.
Oh, it's just well, Goose, you just started an online business, right? Doesn't matter what you sell or.
Yeah. It's
right,
online.
It's a success.
It's online. You've got an ABN, right? You got a PayPal account, an ABN, and you're on the line. So it's the same thing, right? So we just thought,
totally.
So we went and we made all the mistakes. We bought the wrong property in the wrong place at the wrong time. When I say that, so we bought an off-the-plan apartment, had all the bells and whistles, and it was literally right. It was literally like 2 weeks before the Melbourne market collapsed in 2018. And we'd borrowed a heap of money from family and friends because I had no money right at the time. So we borrowed money from family and friends this was our moment. We were going to get ahead. And literally the moment that we signed the contract, we raced from there to some property seminar, and they started talking about positive cash flow properties and all of this stuff. And a penny dropped. And I went, oh, hang on a second. Maybe we didn't put enough thought into this. But of course I had too much ego, so we didn't pull out of the contract. We're like, no, it's a great decision. But it was that kind of realization of like, oh my God, if I made another mistake because I'd obviously made a few in life, I was like, oh my God. And I sort of went on this journey to really try and understand it, because I could see all these people that were crushing it, absolutely crushing it. And I was like, I'm missing something here. So over the course of about 12 months, Gabby and I spent about $100,000 on courses, like spruikers, basically. If you name one, we've probably done it. The good thing about that is we saw a lot of what not to do in the industry, and we saw a lot of how people get hurt and damaged. But through the process, particularly myself, I got super into trying to understand how all of this worked. And I'm talking, staying up all night with spreadsheets and trying to understand it. And what I started to understand was a couple of interesting things that you can go very wrong in property, but if you get it right, it's got a magnifying power that I can't see in any other asset class, and it has the ability to create more change, more impact, more wealth than pretty much anything else I'd ever seen. And it's all just about getting a few fundamental pieces right. So it was in 2018 that the penny dropped for me. And I remember having this moment where I was like, hang on a second. If all you need to do is combine three elements, firstly, it's not easy to combine the three elements, but if you can combine three simple elements in every property you ever buy, firstly, you can continue to build a scalable property portfolio. Secondly, you can create a situation where you don't have to work anymore. Like it was actually too much. It was too much. I felt like I'd taken too many drugs or something. Like I was a bit overwhelmed. And so I went to disprove it. I was like, it can't be like this. Surely not. Surely that these ideas that I had and this process and this formula I put together didn't work. So I went and sought out a lot of successful investors, brokers, all kinds of, I was like, I needed to disprove my theory, because I was like, it can't be this simple, because if it was this simple, everyone would do it, right? But time and time again, I was told that actually what I had worked out is just the thing that nobody else had worked out. But the biggest issue with what I'd worked out, which is what we call the Holy Trinity, and we can talk about that later, is that it's hard to find, right? If you can get cash flow and capital growth and the ability to control the asset all in one thing, that's great. But then the reason that most people don't do it is it's really hard to find. But once you understand, once you can kind of see through a gateway, and you transform the way you think about wealth and everything like that, it's like there's a piece of your psyche which opens up that you can't close the door on very easily. And so then it just went, okay, well, how do we find it? Because if you know that you can get the ultimate solution, the way that I like to think about this is if you know what greatness is, to aim for anything else is to aim for mediocrity. Like if you know what greatness is and you just go, I'm not going to work that hard, I'm happy to go halfway, you're deliberately seeking out mediocrity, and life is too short for that, in my opinion. I know that was a bit of a ramble.
No, I like it, but I have more questions.
Go on.
Okay, so I mean, we will discuss the Holy Trinity, I think, probably in another episode, just because I like where we're going with this episode at the moment. But two curious points there that kind of look into it is that, you've gone on this big exploration and look at things. And as a business owner, like I was much in the same thing of like, I'd heard people doing really well in property.
Yeah.
But the numbers weren't making sense. I also heard of a lot of people getting burnt or taking a loss in property as well. So if you're a business owner, like how do you sit there and actually say, instead of reinvesting in my business, that I'm going to come over to property now and start thinking about diversifying or taking some of my profits out? Like, how do you make that discernment that that's the move? Like, you've had this big experience, but that's kind of shown you the light of, okay, well, this is what I want to do it. But for other people, they may not necessarily transition career paths and have that same experience.
100%. So what you're really saying is, why would you bother taking money out of the business?
Absolutely.
Yeah, and that's a really great question, because for a lot of business owners, there's a few different types of business owners. There's referral-based business owners who've got they've got a relationship capital business, which they don't have to necessarily invest money to generate more revenue. So they've got a pretty reliable system going on. So they're like, why would I don't know, like, I've got a nice life. Why would I change anything? Then you've got the other type of business owners who actively invest in marketing strategies where they might get a 5x return on their ad spend and stuff like that. And they're like, hang on a second, I can get 5 times. I put in $10,000 and I get $50,000. Why would I invest in something else?
To be clear, that was the exact thing I wrestled with for a while when I looked at it. And I was like, okay, I can invest more in here and get this, and then it's over here.
Do you know what happens though when you invest $10,000 in ads and get $50,000 of revenue?
Have to do some work?
Yeah, you've increased your workload. You've actually increased your workload. So you haven't given yourself any more freedom. You've just made yourself busier, right? So you're essentially just feeding the machine. You're just making a bigger machine. So rather than actually working out how to step outside the machine and create a better machine, you're just working out how to create a bigger one. And bigger is not always better, particularly if you actually want to do anything else in your life other than working business, right? So
I would even go further to say some businesses just aren't systemizable to the point as others. Like, if you're a brand business, like I'll say Oprah, right? Oprah's still got to get on that stage. Like, her talking plays a heavy role. Surely she can get leveraged and all the rest. But the reality is, the more shows she does, the more she's showing up.
Totally. You mentioned an interesting word there, leverage, right? So the thing is that even, like, let's just go to an extreme. Let's say Oprah, right? Or Jeff Bezos. What do they, let's just say they made $100 million in cash. They had $100 million in their bank account. What are they going to do with it? What then? Like, are you just trying to pile up money? Like, what's the point in being in business? Like, what? You got to ask yourself a very big question. It's quite challenging for a lot of people to ask themselves big questions. A lot of people actively avoid asking themselves big questions. And the big question is, what are you even doing this for? Like, why are you even here? Now, a lot of people will have a mission-driven business, and that's great, and that's fantastic. But at a certain point, you're going to have to think about what's next and what else is there. So now you can think about retirement. You can think about exiting. You can think about mini retirements. You can think about legacy. You can think about all of those kind of things in a variety of different ways. One way is pile up the cash in the bank and hope that you've piled it up big enough and that you die fast enough that you don't run out of money in the meantime.
That was my first strategy.
Yeah. I had this conversation with my parents when they were like going through their whole like retirement planning and stuff like that. And I was like, guys, we can do this, we can invest, we can do that. And mum was like, well, we've got like this much in super and this and I'm like, okay, cool. Just as long as you die fast enough. Which is a brutal thing to say, but it's like, it's hectic because if you don't die quick enough, you're going to die broke, right? And hey, who wants that? Particularly if you've spent a whole bunch of time, energy, and money and risk trying to build a business so that you can avoid that kind of thing. So here's the thing. I'm not saying don't do business, and I'm not saying to take all of your profits out, but at a certain point, you've got to look at what is a meaningful amount of money to leave on the table in your business? What is a meaningful amount of money to take off the table in business, and what can you do with it to build a risk mitigating, wealth accelerating strategy? So I'm not sure if I've answered your question.
Well, I will re-ask it in a slightly different way to make sure we do here. But it's like, I think the thing I asked more specifically is like, why wouldn't you keep reinvesting in your business? Why would you consider moving some out?
Well, that's a good question. That is a good question. So, business, as we touched on, is very active. That's a big one. And so if you can create something that doesn't require you to, and we touched on leverage just a second ago, if you could take your money and put it in something that can actually make you money without you having to do anything, that's ultimate leverage. So rather than you putting more money into growing your business and creating more work, more stress. All right, you build a bigger business and a bigger business, and you go from 5 employees to 20 employees to 50 employees to 100 employees to 200 employees. You've got middle management, upper management. You've got an executive C-suite. You got all this kind of stuff. You get listed on the stock market. How cool! Like, sounds fun. It sounds awesome. I'm down. I'm super down with that. But wouldn't it be nice if you had a little piece of your life that was doing all of that by itself, that was increasing your wealth base, your net worth, was increasing your residual income stream, right? Because I know a lot of people who like, and we were talking about it, you sent me a book the other day, billions to bust. You know, it doesn't matter how big you get. There's always a risk. And this is kind of the inherent issue with business. Is it's super active and it's super volatile. All you need to do is look at the share market, which is a representation of business, right? It's the business line, right? It's like all over the place. It's up 40%, it's down 60%, it's up 80%, it's all over the shop.
Well, this is what brings me back to my earlier point. I'm sorry to interject, but it's like, this was the Kodak moment. Is like, you look at what's going on in the world right now, you would have bet pretty heavily that gyms and restaurants were safe here. You would have gone, that's totally a safe industry. And then somehow a guy that makes properties on the internet, so makes podcasts and videos and has a media company, that's the safer option?
Yeah.
Like, you're kidding me, right? And then if you think AI isn't coming for my industry, it is. Like, I don't think media and internet experience we have today will exist in the way we do 20, maybe 25 years from now.
Oh, absolutely not. Absolutely not. I mean, there's a lot of advancements in the media space. I was reading a lot about deepfakes yesterday and just how insidious deepfakes have gotten. And there's a whole bunch changing. But the thing is that changes all around us is business changes all around us, industry changes. I mean, right now you've got retail, which is closing down all over the place. You know, industries and business shift with the times in a massive, massive, massive way. The reality is, and I'm not here to just like trying to beat an old drum, but the reality is real estate is super stable. Like, everyone needs a house. Maybe they need to rent, to live in, or whatever, but it's super stable. Now, a lot of people might think, why would I take money out of the business to invest in something that is really slow, is really complicated, doesn't really give me much back for my money? They've probably heard about negative gearing. They're like, why would I take something that's profitable and take my profits and put it into something that costs me money? Because that's essentially negative gearing. And so you've kind of got all these thoughts that percolate around in the brain of a business owner. They're like, hang on a second. I've got this one thing that I do and it makes money, and it makes it fairly fast, right? Really consistently. But then if I take that money that I can make fast, consistently, and all of that kind of stuff, and I put it into something that either costs me money, is really slow and it's really complex, and I could get it wrong, and I heard lots of people lose a lot of money, and oh my God, it's like, you're 100% right. Why would you? And herein lies a really big challenge, because what I worked out was that it doesn't have to be that way. So the average amount of time, the average kind of like the regular strategy, the old school strategy, typically the strategy of like probably your parents' generation and stuff like that, was try and buy 5 properties. And I use the word try very, very clearly. Try and buy 5 properties, and then try and hold those 5 properties for 30 years. And then at the end of 30 years, they will have paid themselves off, and hopefully they will produce enough revenue to replace your income. Yeah, there's a lot of try and hopefully there. The reason there's try and hopefully is because most of the time people have negatively geared assets, have negatively geared strategy, which means that, for those who don't understand what that means, really simply, the asset produces less revenue than it uses. So therefore, it makes a net operating loss. Okay, it loses money, and then you get to claim that loss back on tax, which sucks, because who wants a business that loses money, right?
Well, to your point, that's, if you're a business owner, that's like opening up a new division of your business intentionally to lose money to bring down your tax bill.
Totally. So it does work though. Like, look at Uber. Uber's a negatively geared business.
Yeah, I think that's a different strategy, but kinda.
Well, they make a net operating loss in the quest for growth, right? And look, so it happens, and you can draw those similarities across. But you're right. It is the way I like to think about property is that you've got 2 components. You've got land, and then you've got a shop that sits on top of it. Now, the shop could be a 3-bedroom house, or it could be a unit block, or it could be a duplex, but it's essentially a shop. And you're, as a property investor, you're also a business owner. It's the business of real estate investing. And that shop that you have on your piece of dirt, now the dirt is what you buy that goes up in value, because the shop that you put on top, that's going to go down in value because paint fades, timber wears out, roofs get older, taps wear out, it all depreciates. However, you're in the business as a property investor of selling accommodation solutions. Okay, so then your target market and your clientele are going to be dictated by the type of shop that you have. Okay, so you've got to then think about how that's going to work in the different markets and stuff like that. But if you think about it like a business, okay, I've got a shop on a bit of land, and do I want my shop? And you could psychologically exchange that for a milk bar, right? Do I want to buy a milk bar that loses money? No. Like, I don't know anyone. If you said, hey, would you like to buy that milk bar? It loses money every week. Do you want to buy that? It'd be like, no, why would you? Like, that's just crazy talk. But that's the kind of thing that the stats speak for themselves. 93.1% of property investors never get past 2 properties. And there's a big reason for that. Firstly, they don't know what they're doing. Secondly, they're negatively geared and they've got properties which lose money. Firstly, why would you even want to keep going in property if you were losing money in your properties every week and it was costing you money? Secondly, you reach a debt ceiling that you won't even be able to service any more debt and keep going. So there's a huge piece there that when you start getting assets which, you know, if you believe that real estate investing is slow, it's going to take 30 years, and if you believe it's going to cost me money, negatively geared, and if you believe it's really complex and really hard, then absolutely, why would you take money off the table when you could do what you already know how to do? But I think that's the paradigm shift that business owners need to start to understand, is that all of those things are wrong and they're a lie, and it doesn't have to be that way anymore.
It's so interesting. You just described the breakthrough I had with thinking about property was thinking of it like you're owning hotels, thinking of it like you're owning an accommodation business. And then it completely shift. Like I was like, sweet, just buy something on my street that I can like keep an eye on. Like, because that's what I want to do with my time. Anyway, and then the next thing was if I view this as a business of accommodation, it suddenly becomes easier to realize what is good and not so good in areas. Like, oh, hang on, maybe people would be more likely to want to use my accommodation if it's near a beach, near good schools, near jobs and opportunities, maybe near some infrastructure or hospitals. Like it really gets you to think differently about, well, I'll put it this way. It made me see so much more clearly of when people go into property looking for security. So buying something that's near them because it's comfortable for them versus like, would you start an accommodation business of some kind in that area? It just completely shifts the view on like what is and isn't necessarily a good idea, and what maybe was a good idea 20 years ago for our parents might not be now.
No, absolutely. Absolutely. And I think that's a big fundamental mistake that a lot of people make. They say, I want to invest. It's my first investment. I want to invest close to me. I want it to be nearby. And I always say, why? Well, just so I can, just so I can keep an eye on it. I just want to be able to, I'm like, hang on a second. Are you telling me that you're going to go and peek through the curtains with the tenants that are in there? I'm like, dude, that's like, you're going to get in trouble for that shit. And the other
I'm just like, that's exactly what I thought. I was like, oh, if something goes wrong, like, oh no.
So then the other thing is like, but what if something breaks? I'm like, all right, hang on a second. So what you're saying is that when the plumbing breaks at 1 a.m. and there's shit everywhere, you're going to go over there? You're going to go, well, no, I'll call a plumber. Well, actually, that's not even true. Your property manager will call a plumber. You're supposed to be sleeping at 2 a.m., right? So why is it even relevant where it is for a start? And the other thing I always say is, how often do you visit your shares? I check it out online. Yeah, cool. I can do that for you if you want. You can check it out online. Go look at it online. You don't need to go there. The reality is it's statistically improbable for you to be able to invest in your own backyard and simultaneously just so happen to invest in the right property at the right place at the right time to get the right growth and to get all the right stuff. It is so statistically improbable that it's laughable.
I can see that now. I really can see that now. And I'm just do you ever look back on yourself and just go, what were you thinking?
Yeah, I do. I've done that a lot. But I think there's a lot of myths and mistruths out there about real estate, about firstly how hard it is, how slow it is, and the limited returns you can get out of it. I mean, we were talking earlier about some of the results we've been getting for our clients. And we were laughing, and this is before we started recording, because it was like we sort of can't even talk about it because people don't believe it. And you said that you had a belief threshold when you were starting in property. What was your belief threshold of what could be possible?
Well, this will give you an insight into how my mind works. Is like before I picked property in general or picked it, I said like, okay, well, there's investment classes available. Like I could just buy another business, or I could invest in shares or bonds or gold or Bitcoin or whatever it is, and property. And I actually first went down the path of shares. I will admit, shares. I liked business. I thought, again, this is somewhere where I could have an insight. Mm-hmm. But ultimately, I chose against shares. Just quickly, I'll discredit shares. This is an opinion. But I was like, I found that shares was way more active than I intended. I thought that a property seemed more active, but actually I found myself checking the news a lot. I found myself also realizing how little influence I had on the share price. So it kind of discerned me a little bit. And I just realized there's some bigger forces out there in the share market where you can lose a lot of money fast, just completely out of control. There's some whales and heavy hitters out there moving markets, in all honesty. The second component is you can't add value to a share. What are you going to do? Like buy shares in Coles and then just go and just buy heaps of stuff at Coles, jack it up? Like, how are you going to influence? Or you can do that in property. But anyway, when I started to research, I was like, you can get on Google and say like, what's a good return in each of one of these ones? And I got onto property and I said like, well, what's the average returns been like? Like what have people done in the last 20 years or even the last 10 or 5? And like, how does that look? And quite commonly, I got into some forums and there was kind of this range that if you were able to produce a 5% return in property per year, that you would be at the upper levels. Like if you're doing 5% annually on property, because you're dealing with some big numbers, 5% on $1 million is a lot of money. It's not a small amount. So I'm like, right. So like if you can get a 5% return consistently, like that's the benchmark of what good is. I'll be a high achiever there. And then I also saw yield above, I was 4% yield. I was looking in Melbourne, I will say, where 4% yield is like, I would think a good yield. And I was like, okay. And then the other side of that was like, all right, to your point is like, how many properties do people get? So I developed this, all right, I need 5 properties. If I can get 5% per year and a yield of 4%, like that's how it's done. Like that's the end game. It's like dissecting a business and trying to reverse engineer it with no experience or knowledge. So it seemed logical. So when I saw anything outside of that, I was just like, nah, scam. This guy's a spruiker.
Yeah, totally. And you touched on a couple of points there, like when you're comparing returns though. So even if we were to use that example of say 5%, let's just say a 5% return. Now, let's just say you took $100,000 and invested in shares, right? You bought $100,000 worth of shares and you got a 5% return, right?
It's common. I looked it up. You can invest in like let's call it AFIC, which is Australian Foundation Investment. Like it's one of those diversified funds, and you will get on average, I think even probably higher than 5, but in general 5%.
Yep. Okay. So you put in $100,000, you get $5,000 back at the end of the year, right?
Yep. That's your yield.
That sounds shit. Why would you put in $100,000 and get $5,000 back out? Okay, so you could put $100,000 in ads and get more than $5,000 out. So why would you do that? Why would you put it? Why would you even take your money out of your business and put it in shares? You're only going to get $5,000 for $100,000. Whereas in real estate, if you took $100,000 and, for example, invested it in a $500,000 property, and you only got 5% a return, that'd be $25,000. So you've got 5 times the amount of return, purely by using leverage and all of that kind of stuff.
Oh, you just hit on something there, Goose. This was the one that, again, like call me naive a little bit. I definitely am and still was and am still. And I'm very aware of that, of like just how much I don't know these days. But it's like I'd been very debt adverse. So for example, I'd paid off all my business debt before I even looked at investing at all. I made sure we had no liabilities. We're very cash flow positive. And then I was like, okay, I've got this surplus over here of cash that I can start putting into investments. That was my whole strategy.
Yeah.
What I didn't understand properly, and probably still don't at the level that yourself or others might be, is just how powerful debt is when used constructively. And you use that example, which I think is a really good one, is that if you were going to invest $100,000 in shares and you got 5% versus leveraging $100,000 into $500,000 in property and getting 5%, like there's I think they call it an exponential difference. And I know some people will nitpick on, interest and risk and a whole bunch of other things, but I think there's ways of kind of mitigating those or doing things different.
Well, dude, sorry to cut you off, but 100% there is a way to mitigate the risk. The way you mitigate the risk of your debt is you make sure that the asset produces more income than it uses, so it pays for its own debt.
Yeah, that part I didn't necessarily. As I said, this is where we go back and I'm looking at my 4% return. All right, so I'm looking at my 4% yield on this property that I'm going to buy, and I'm just thinking to myself, it's going to cost me money. I'm going to have to put money into this every week. Like I'm actually going to be kind of running at a loss unless I've got a big enough deposit to make that work.
So I think herein lies like one of the biggest issues is you've touched on, because most people don't understand how it works. So if you don't understand how something works, then of course you're never going to think it's a good idea. I mean, I can use an interest. So you're talking about 4% yield. 4% yield and 5% growth.
Yeah.
Right. So I can look at one of our clients that we purchased a property for 12 months ago, and these are real numbers. This is based on bank valuations. This is not hearsay. This is not conjecture. This is verifiable. This is legitimate. He bought a $229,000 property just over 12 months ago, and it's now valued at $333,000. Okay. So that is 45.4% capital growth. Now you might think 45.4% capital growth. Surely that's a lie, right? What do you think about 45.4% capital growth?
You told me a similar story not long ago, and my answer was because I was like, that sounds like bullshit, to be honest.
Totally.
I easily trips my bullshit meter.
Totally. Well, here's the thing. If you want to, let's just trip this a little bit further, because I want to just use this as a little exercise to help show people what is actually possible. I want to use some real numbers. So if he bought that property for $229,000, now very roughly, we'll just do some general maths here. It cost him about 27% in acquisition costs. That was deposit, buyer's agency fees, stamp duties, and stuff like that as well. So 229,000 times 0.27. That is $61,830. Okay, so he took $61,830. This guy's an IT analyst. He's from Perth. So $61,830. Cool. Now, if he made a 45.4% capital gain, so that's $330,000 minus the $229,000. So that was $101,000 profit. Okay, so he's invested we'll call it $65,000 to make $100,000, just for simple maths. So what that means is that he actually made 155% return on his capital in 12 months.
It's just insane.
That's absolutely insane. And the reason he was able to do that was firstly, obviously, by buying the right property, but secondly, through leverage and all of that kind of stuff. So this loops back to that question, why would anyone bother taking money out of the business? Well, firstly, because they think you can't do it in a good way. But if you could take money out of your business and get 155% return, by the way, so just back to the yields, that didn't even factor in the yield. It's a 7% yield, right? So it's producing that particular property produces about $4,500 net cash flow a year. So this starts to answer the question. You can't answer it without actually starting to talk about what's possible. But the thing is, you have to start breaking down the paradigms of what people think is possible for people to understand why you would even do it. Because I agree with you. If you were only going to get 5% growth and 4% yield, well, why would you? That's quite simply, why would you? Why would you bother?
So you go back to the cash stacking strategy and just hoping I die quick enough. Like we'll work that one. But there's something I really want to dig into there is like, and you kind of mentioned this before about like when you were with your business partner and you said, okay, well, you just buy a property and it doubles in 7 years.
Mm-hmm.
When I visualize that myself, the mechanics are, okay, well, you buy a property and there's some sort of linear graph that everyone agrees to. Yeah. And like all properties just go up like in that little increment. So if you maybe buy in a good area. But I didn't necessarily understand, and this is one of the things I would really love for you to speak into a little bit and even share on, is there's actually like very different ways of thinking about it. So for example, an area gets a new hospital or an airport, or there's some systematic change to a location through government or industry. That's the type of thing that can really influence an area. I probably just stole a little bit of your thunder and sounded smarter than I am. But those types of things I didn't understand or even could conceptualize, which could have a huge influence on this industry as well.
Totally. I think we need to zoom back out a little bit because you're right. Hospitals, schools, infrastructure, stuff like that. It's all super important. And in fact, if in the Investor Lab podcast, we've got a whole series on how to find how to identify those core elements. There's 10 core drivers. There's actually a few more than 10, but there's 10 core kind of infrastructure drivers and stuff like that. Now, I think we need to zoom back just a little bit though, because you need to remember that property is non-linear. So if we go back to say the start of the 2000s, so the first decade, 2000 to 2010, like everyone talks about Sydney being the mecca for property price growth, but for 10 years it was the underperforming. It was the SIGSAD cousin in the property market in Australia. It didn't do anything. Like it was basically a swamp, right? In terms of like market movements and stuff. You know what was going really, really well at that point in time? Darwin, Perth. So property markets move in cycles, but the problem with saying cycles is that people think it's a circle. They think it goes up like a clock. You hear this term, property clock, and they think, all right, it goes up and then it reaches a peak and then it goes down and then it gets to the bottom and then it goes up and then it reaches a peak. And they think it goes up and down like a bicycle wheel and around and around and around, which is that's nonsense too, right? That doesn't happen. If you look at any graph of property price growth in Australia, it's not a circle; it's a line, and it goes up. Right? Simple. So the thing is with that is it's also not like this timing thing. People talk about it happens in 7-year cycles or 8-year cycles or 4-year cycles, and that's a lie as well. That's not true. So what actually happens is that property markets do move in cycles, but they're economic cycles, they're psychographic cycles. There's all these kind of things that happen as we change as a community and as a society that force these kind of changes. Now, some of it is manufactured by private industry. So for example, one of the places we're investing right now, there's like heaps of new private industry, big, manufacturing plants being built and heaps of jobs, people moving there. Good. That's good. So you've got private industry investment, and then you've got public investment. Okay, so governments, typically governments they plan well and truly ahead. And remember, governments are just a business as well. They want to, okay, we need to get more rates over here, so we need to make it better so we can charge people more money to live there. And then they'll do systematic improvement strategies. Now, systematic improvement strategies could be anything from how do we make it nicer? I don't know, build better parks, to like, how do we make it more livable? I don't know, build better schools, all right? So there's those kind of things, and they influence these kind of cycles as well, or these movements. But then you've got socio-psychographic shifts, which is a big one that's happening right now, where people are going, well, I don't necessarily want to live in the city anymore. And then they're making lifestyle changes. So we've seen this a lot with sea change and tree change and all these kind of things, which is why, as you said, if I had an accommodation business, I'll put it near the beach. That might go maybe, and it really, really depends, right? You actually have to have multiple factors working together. So it's when you actually start to understand what the core drivers are, you can actually start to work out, well, where is the best place to put my money and at what time, based on what is the microcosm of key events that is going to influence and impact that movement at that point in time. And once you start to understand that, you can start to really crack the code. Because I can tell you, a lot of people talk about Sydney and Melbourne as being like the property market. And in fact, any media that you hear where they talk about the property market, they're talking about Sydney and Melbourne. You've got to remember that 17 million Australians live outside of Sydney and Melbourne. Like most of Australia is not Sydney and Melbourne. And so you've actually got to take a much broader macroeconomic look at what's actually happening and moving around. And interestingly, what you find is that because there are so many moving parts, you've got private, public, psychographic, sociographic, demographic. You've got all of these kind of different influencing factors on what makes markets move and why. And you've also got huge supply and demand and heaps of other stuff as well. What you can actually see is that sometimes a cycle can be as short as a couple of years. So, for example, if you look at Ballarat and Bendigo, they should have been coming off the top of their cycle, but they're actually having a second increase. They've gone from the top back to they've gone from from 12 p.m. back down to about 7, and they're moving again. And that's because of a whole bunch of different stuff, largely because people are trying to get out of Melbourne right now. And so once you start to understand these things, you can start to actually transform this idea that, well, I'll just buy and hope. That's really the traditional strategy, buy and hope. Well, I think... I don't know. I think Preston's good. A few of my mates have been moving around there. I guess that means other people want to move around there. I'll buy in Preston, and you just hope that you've done it right. And then, I don't know, I'll just wait and see what happens. And that's the difference between getting, say, 2, 3, or 4 or 5% growth and getting 45% growth.
It's like this conceptualization of, again, you're kind of like unlocking another layer. Is like you go through you're buying a property to then the security, potential security, I shouldn't say security, potential or perceived security of buying in a capital city like Sydney or Melbourne. And then when you start to really think about some of these nitty gritty ideas of like, as you've mentioned, like, hang on, everyone's trying to get out of Melbourne. There's a very real reason why Bendigo or Ballarat or something like that might see different gains. And you start to see that how this is kind of coming together, like what's actually possible when you start to lay these. It's very, very cool. Very, very cool.
Totally. It's a very contrarian view, but Sydney and Melbourne are actually the two most volatile markets in the country.
Interesting. Why do you say that?
Because it's true. Like, I'm not just making it up. It's not an opinion. If you look at the market movements and market cycles, and you look at the aggregated median price of those two cities, and you can look at them on the greater Sydney and Melbourne and shrink them down and look at them all kinds of different ways. And of course, every time you look at data differently, you'll see different results. If you actually want to know what's actually happening in any market, you've got to get down into about the size of half a suburb, and that's what we call a microburb, and you can start to see what's going on there. But if you look at Melbourne, 2018, it crashed down, and then 2019 it started going back up, and then 2020 it's down again, and it's all over the place. It's a roller coaster, right? And the reality is, as a business owner, you want to try and escape that roller coaster, right? Like, you actually, like, I don't know, but if I'm gonna have a volatile strategy, I want to be in control of it, right? If I'm gonna have a volatile strategy, I'm just gonna be in business, and I'm gonna at least be in the driver's seat of what the hell's going on, right?
Totally. I want the volatility in my business, not in my investment portfolio.
No, exactly. And the same thing goes for Sydney. It's up and it's down and it's up and it's down. And the reality is, it's because of affordability and price brackets. Okay, so as wages haven't increased at the same price, same rate as property prices and rents and all of that kind of stuff, the less affordable areas are way more volatile. Yep, you can make bigger gains because the swings are bigger, but it's the same as investing in highly volatile. It's the same as startup investing. Your gains can be massive, but it could be all over the place. And the fact, like, it is just pure fact that Sydney and Melbourne are the two most volatile markets in the country.
Something you learn every day. I would never have guessed that at all, or even perceived it, just because of, well, I don't know, maybe they got a good PR company.
Totally. Well, yeah, they've got Rupert Murdoch, who seems to be shouting all the good and all the bad about them all the time. But I mean, look, we've covered a lot of ground on this episode, Charlie. What do you think, like, as a business owner, what do you think? Is there anything that we've missed that you think somebody who has been thinking about investing in property, or maybe has never been thinking about investing in property, is there anything we've missed that we should have covered that we haven't, that we're not going to cover in a future episode?
Can't guarantee we won't cover it in a future episode as well, but I think if I was to have someone listen to this episode and you said to me, like, how do you want them to be different after this? Is I really want them questioning what's next for them, like, really what's next. And really, like, through that lens, and hopefully the same lens I viewed it, is like, is your industry really going to exist in 20 years? Is it really as safe as you thought it was? Or is this something where you need to start thinking and planning a bit longer, where you can, I don't know, for me, it was all about ensuring that I suppose looking after my family and my parents was a huge driver here. But that would be the thing, is like, just really considered, are you in the position you want to be and set up for the long game?
Yeah. I think that's a good one. I think it's good. That's a good point to round it out on, because, I did an idea pressure test on this the other day, and I looked at some of the most stable businesses that I know, like recurring revenue models, stuff like that. I looked at those kind of models where they're like, maybe I've got, say, 10 years of recurring revenue. They've been doing their thing. They've got memberships and podcasts, and they've built heaps of brand equity, and, they've got heaps of leverage and a good lifestyle. And if they stopped doing that, even if they maybe only work 10 hours a week, right? Or 15 or 20, I don't know. But those kind of, I had to look at a few different people that were in that kind of realm. And I said, what if they stopped?
It's the big question, isn't it?
Yeah. What if they stopped? If they stopped doing the podcast, and if they stopped coaching, or if they stopped writing more ad copy, or what if they stopped? What would happen? And I think that's the big question that a lot of business owners need to start asking themselves. Boom.
I don't even want to say anything because I'm like, that is such a perfect end note. So I just amen, Goose. I dig that a lot.
Awesome. Well, Charley, let's do this again. Let's keep unpacking the ideas and strategies and everything around property. And mate, let's make a difference.
Absolutely.